Hi everybody and welcome back. So in this lecture we're going through an introduction to the IFRS 17 balance sheet and a little bit on how profit is handled. So last time we did the first couple of sections here, so the IFRS 17 versus Solvency 2 and the IFRS 17 balance sheet. And the important point to kind of take away from all that is just that the IFRS 17 balance sheet is different to the Solvency 2 balance sheet. So you're going to get a different calculation for how much free assets the company has. Okay, let's go into the next one, which is the IFRS 17 best estimate liabilities. So let's call this IFRS 17 BEL for short. Okay, most important point here is that the IFRS 17 BEL is not the same as the Solvency 2 BEL. Both are calculated by discounting future cash flows on best estimate assumptions, but first point is the discount rates used are not usually the same. So if the cash flows are discounted at different rates, then you're going to get different results for what the BELs are. There are other differences as well. So the IFRS 17 BEL excludes overheads from expenses. So initially that seems really weird, and it definitely surprised me. The overheads don't disappear from the accounts, they're just dealt with somewhere else in the accounts. They're not dealt with in the kind of calculation for the profitability or the balance sheet for the insurance cash flows in particular. So I'll just make a note on that. So open bracket, they are accounted for elsewhere. But you can imagine that if your overheads are significant, that's going to create a big difference between the IFRS 17 best estimate liability calculation and the Solvency 2 calculation. I'll add in one more difference, and that is which premium cash flows are included can differ. So not all future premiums will necessarily be included in the IFRS 17 calculation. For a lot of insurance contracts it's going to be the same. I'm not going to get into that in detail, but for some there could well be a difference. So all three of these things together, the discount rate thing, the exclusion of overheads, and which premiums are included, can all lead to the IFRS 17 calculation of the best estimate liabilities being different to the Solvency II calculation of the best estimate liabilities, even though best estimate liabilities, or BEL, is the same word or the same acronym for both of these. So just watch out of that. I'll just add in something else that you should be aware of. Again, just in terms of if you're reading through IFRS 17 material. So note IFRS, in fact let's just do that again. IFRS 17 BEL is sometimes called present value of future cash flows. Okay. So that's what the stuff that I wanted to say about the best estimate liabilities. The next component in the balance sheet is something called the risk adjustment. So let's just tick this one off, and we're going to look at this risk adjustment thing now. Okay, risk adjustment. RA is an amount to compensate for uncertainty in BEL for, in inverted commas, non-financial risks only. So what do we mean by non-financial risks? I mean things like, basically things that are not to do with market risk or investment returns. So i.e. Expenses up or lapses up or down, or claims up. So all of these kinds of things could happen. So if you remember, actually back to Solvency II, you've got this. We take the market value of liabilities and we often break it up into two sections: the best estimate liabilities and the risk margin. And the idea is kind of, if you're going to pay somebody to take on the liabilities, paying them the BEL wouldn't be enough. They need some extra money as well. And that risk margin is some kind of assessment of the extra money that they would need. You could argue that the risk adjustment is kind of similar. It's an additional amount of money on top of the BEL in order to compensate or allow for certain kinds of risks. It is a bit different, but I guess there is a little bit of connection there. Okay, we are not told how to calculate it. Now that's quite different to the Solvency II risk margin, where there's a number of different formulas in the regulations as to how it could be calculated. Now what we could do with this risk adjustment is we could use a value at risk calculation with a time horizon, let's say e.g. 20 years, and let's just delete that, a probability e.g. 80%. So we might be thinking about like a 20-year contract, and we need to just make sure that we've got enough money, so we set a probability to ensure that's the case. And maybe we choose something like 80%. Now this isn't necessarily what we do. This thing I'm saying, we make this up, i.e. it's our decision. Okay, so you might choose different time horizon, you might choose a different percentage, you might choose a completely different way of doing the calculation. However, what constrains us is that we probably want to do something similar to our competitors, maybe in the particular country that you're operating. So whatever approach you choose, you don't want necessarily to do something crazily different, because then it makes your accounts less comparable with those of your competitors. And the whole idea here is that, you apply a certain set of regulations to accounts, so it's easy to compare different insurance companies with other insurance companies. Okay, so what does all of this mean? Say we assume that we're going to do this kind of value at risk calculation in order to come up with the RA. Well, if I just get myself some more white space. This means uncertainty up implies that your RA goes up. A bit like the SCR, and a bit like the risk margin in Solvency II. If there's more risk, the SCR goes up. If the SCR goes up, then the risk margin goes up. It's more direct here. If our uncertainty or our risk goes up, then we would expect our risk adjustment to go up for a particular contract or group of contracts. Let's write this out. So in this way, the IFRS 17 RA behaves similarly to the SCR or the risk margin under Solvency II. But the RA calculation is different. So now you have best estimate liabilities different between IFRS 17 and Solvency II. And this risk adjustment is different to the risk margin under Solvency II. Okay, let's take a break here and then we'll come back with the rest of this lecture in the next video.